Hello traders, Nick Shaheen here looking at trying to recap what happened after Friday 8/23. A messy day. Started out good, then scary on a China headline that they're retaliating finally to the early August implementation of additional tariffs from the US. And then markets recovered. And then Powell said some things and market recovered a little more and then off the cliff because of the way President Trump reacted with a tweet storm. He did not take the small win he had because we imposed, I think August 1 announced $300 billion worth of tariffs on $300 billion worth of goods we import from China, and in retaliation China came up with only $75 billion on autos. So that's a win for Trump. Wasn't enough, so he went into the headline and lashed out. The fact that he lashed out, it sounded harsh, and the markets freaked out, and we fell off a cliff. And now what? Sunday night into Monday into Tuesday is going to be violent. It's no time to be a hero, but it's definitely time to be cautious, and there might be opportunities. So today's video is to just look at where the charts are, and what is below, what is above, and this way kind of like try to see if we have a shopping list. So first I'm going to start with the indices, the S&P, the SPX SPY, the fear index, maybe the small caps as well, and then look into some sectors like transports. They were having troubles, and also there's some technical signals that we can take a clue and just eliminate the headlines and say, okay, here's what can happen if this line breaks. The sector that's probably most sensitive to that are the chips. So good companies are going to take a beating unless something changes in the headlines. So is the economy going into the toilet? Maybe. It's not. It shouldn't, unless the politicians keep playing chicken until we crash. So overseas, they're already in trouble. The US is still hanging on. And we have 1,000 cuts, and we just keep putting band-aids that are not working. And there's no consistency. The problem is the U.S., Trump is playing a war of words, but the president of China is not on the other end. It's people in the media, state entities, who knows what. Why isn't Xi talking? Their president. So it's kind of like a weird fight going on. It's like a Bruce Lee movie. I don't know if you used to watch him. As a kid, I watched him. Bruce Lee would be fighting these, white-robed fighters until he kills 1,000 of them, and then suddenly the guy in the red robe comes out to fight at the end. So there's President Xi in the red robe. So he's still hiding behind something. Anyway, back to the charts. So let's look. This is the S&P, the SPX. Most people are familiar with it. It's the actual index. And here is the scary part. We are still inside the white box. And as soon as the white box breaks, this could unfold. We have some stopover points along the way. 2780-ish comes to mind. And if that breaks, then we will test the recent low of May. In May we had a tizzy, and it was a good correction of 7 or 8%. Here we have corrected 7%, and we could get down to a lot worse than that for sure. Just from a technical basis, we could have a 10% correction, which is a legitimate number that Wall Street looks for. The problem is, once we get down there, the 2700s won't hold, may not hold, and if either of these two are breached, this looks like a head and shoulders. It depends where you draw the neck. To me, I don't like to draw the head and shoulders as much as looking at the actual levels that break. And if the actual levels do break, it will be something like this price action. This is a stabilization part from last year. So 2640, 50, something like that. And if not, 2520 or lower. Why do I say lower? Because if you do draw the head and shoulders, it will be a scary proposition. I'll show you what that paragraph was. So let's flip to a pen. All right, so we have action that looks like this, and then like that, and then if we do something like this with this price action and we lose this one, whoops, what's going on here? Anyway, this is the size of the dip that should happen. So from this neckline-ish, this is the size of the dip that should happen. But some people draw the necklines in different places, and the worst way you could draw it would shoot lower than this. I'm not going to call for it. Let's take it one step at a time, so we're not scaring ourselves out of. But here's the point: markets can scare themselves. What does that mean? So if I'm a company and I'm looking to spend some money, I'm not going to do anything until this mess clears itself out. And add to it that the yield curve is inverted. Believe it or not, Friday was the only time. Thursday was the only day it actually inverted during the trading day, and then Friday again at the close it was flat. I haven't checked since then, but we'll check tomorrow. It compiles, so you have actual reasons to be bearish on future growth because of the yield curve. You know, short money costs more than long money, so who's going to do long-term plans? Nobody. So company will stop planning down the line. They will just hunker down and hold their line for a little bit, and that just causes a slowdown. And on top of it, the sentiment. So if I'm a CEO or any CEO on the planet will say, you know what, I'm not going to do anything. This world's going to see some tough times, so they'll stop spending. So this is the SPX. The SPY is almost identical, clearly. One is an index, this is the ETF, they track each other, so we have a range and a couple of different downturns. I have puts in protection, I have calls in FVX, VX, and VIX to protect the oh crap moment, because that's my worry. Long term, I'm not that worried yet, but I'm getting freaking worried because of how they're playing it out. So these are the two. Let's look at the small caps. The small caps is supposed to be mostly U.S. centric, but they do tailor to non-U.S. centric companies. So, okay, the small caps is even scarier because it's already at a neckline for the short term. So I'm going to switch to a weekly candle here to see it clearer. Okay, so if this levy breaks, this is an inverse cup and handle, and should have a move about this big. So what is an inverse cup and handle? It's usually the opposite spirit of attacking a neckline from the bottom. So the rally then comes to a neckline, the bulls try again, come back to a neckline, and it's lower than the first time, so the bulls are getting more tired. Either we do another one of these, or when this breaks, it's like an inverted cup and handle. There's the cup and there's the handle. How far do we fall? Usually, okay, the cup is all the way up here. Usually as deep as the cup bowl. So same concept. We're going to revisit the December lows, if not, but with stopover points. Like this zone is going to be supportive because look, we've consolidated it here. It translates to support somewhere around here. So instinctively I did this and it matches up that. So technically, yes, we could see lower lows than December, but we should have support zones in the middle. Maybe it's a headline. Maybe it does this whoosh down and it comes back out like the presidential election in 2016. We did for like an hour or two and then did this. I don't know. But I don't want to play with fire. We need more information, more clarity. And let's go back to, all right, so what about the good companies like Apple, etc.? So Apple fell off a cliff on Friday for a good reason, because I drew this box and I said, this is a tight box, something's going to happen. And it did. It could have happened either way, but we fell off a cliff because Apple is in the direct line of fire at China. And so far, we had a win with Apple because China chose to retaliate on autos and not Apple. Apple is an easy target for China. It's heavily dependent on assembly in China. I think, the way I believe it, Apple doesn't make anything in China. It just assembles everything in China. So their components, for security reasons, are built here, the insides. They go there to just get put together. But it employs millions of people in China depend on Apple. And I'm pretty sure we will feel the impact here also from Apple if they get hit by some special Chinese headline. So back to support, which was this line. Okay, so this is the Apple situation, short term. This could come quick, and if this fails, this could come quick. So early 80s, 180s. The good news on Apple is if I turn off all the headline, and I should, for the long term, this could be in play. So 250 is still doable as long as we maintain the spirit. Meanwhile, headlines are causing it. So you see what's on the line. Fundamentally, Apple's okay. Headlines could mess it up for the short term, and we shall see there. So this is Apple. Let's look at the chip sector, which is also in direct line of fire. I'm going to go with the SMH. See that blue thing? Similar to the Apple. Again, this is weekly. Violent week. We were rally. Then, luckily, it's still a higher low, higher high on a weekly basis. Higher low, higher high. So if we're above this line here, 106 on the SMH, then I'm okay, because it is a point of contention for the whole 4 or 5 years. So this is where bulls and bears like to fight it out. It should be support. One candle like this last week, and we're below it. So it is a pivotal moment that's coming for these guys. Again, over the long term, these are okay. Some companies have more exposure than others. You should do the homework on which companies you're betting on. I don't know. This was a pivotal point. This is same chart on a daily basis. Oh boy. Okay, so SMH, again, chip sector. If I eyeball a line right here, I get this kind of action. So head and shoulder-ish. I know technicians will say, no, the headline, the line should be here. And either way, this is at stake. Eyeball, it's actually a little more. It should be the height of this. And so if we fail here, we better hold here, which is I'll try to get percentages as soon as I zoom out of here. If not, the the May lows could be hit, and if not, then we'll go lower. So let's see here, from eyeball from here to here, was it? So we could have another 5 to 8% at stake because of what happens in the next 2%. So if on Monday we're down 2% here, 2-3%, then we could have another 5% stake from there. This is all eyeball to see the impact. Technically the impact. I don't know what the headlines are going to say. Okay, the G7, by the way, is ongoing, I think, so somewhere around the 26th. So we don't know what's going to come out of it. They're going to sit in their room and not talk about this. I find that hard to believe. Also, we have some talks between China and the US scheduled. I don't know what happened to those, so we're kind of confused about that. All right, so what about other companies? The transports, the Dow theories and all that. I'm going to go to a daily chart to reset. There we go. Kind of like the small caps, bounce or else. You have companies in there like FedEx, UPS, and the railways. FedEx is a chart to avoid at all costs for me. It's just terrible action. UPS is a lot better, and they're almost in the same business. A heavy day in volume. These are 2 heavy red days, and they were bottoms. Maybe we hold some solids into that, but this didn't work here. So definitely caution there, because look, if we go to here, this period of time, we had similar action. Let me see if I can show you. Technically now I have nothing against these companies. I'm just telling you, except FedEx. Technically, so this is a cup and a handle. Actually, why do I keep doing this? The cup is way up there, and the handle is somewhere on here. And here's a cup that started that we can't see, and this is its handle, and this was a neckline kind of like this, right? See, I don't know what's here. We'll zoom out, and then look what happened here, off a cliff. So off a cliff, this blue line. We'd be lucky if we stop here. Why do I draw the line to here? Because I see it like a cluster here, even though the low was here, but there's a cluster. This was a panic moment. I don't know what happened. Is that Christmas? Yeah, that's Christmas. Okay. So I'm going to go to a weekly chart to see what the action was before that cup. Okay, so this is the situation I was comparing it to here. So yeah, big cup, Anyway, we're attacking a neckline, but oh, okay. So the neckline is pivotal. Check it out. I'm glad I did this. So it shouldn't be easy going lower. It should not be easy. Okay, if I do this, this was a moment, clarity moment for a nice rally, and then came back to it and a nice fall below it. But that was the Christmas crash X, and then back above it, and then boom, hard bounce above it, right? If I extend it, same line, orange line comes across. Look at that, almost to the penny here. R again, R again, kind of base for a big rally. Look at this, almost to the penny here. Support, support, failure, breakout, support, and now support with a question mark. Now here's the thing, this line right here is the 5-year hotly contested the volume. This is where bulls and bears fought the hardest, right here. So even if we lose here, this should be support number 2, which should stop us from going to Christmas. But it doesn't stop the red this week. Okay, so this is the transports. All right, who else? Oh, financials. They're in the line of fire of what? Of the yield curve. And yields going up and down. We have no idea what's going on there. That's another thing I need to check. Bonds. So yields going up and down. This is a tight range. The candle spans almost all of it from Friday. If we fall off here, same comments as the IYT. We have some downside technical support from the action, but we really don't know where it's going to go. And these are great companies, already cheap, but they can get cheaper. But if I own them, I shouldn't panic out of them. For example, Bank of America. I mean, okay, so it sells at almost book value right now. Is it going to be selling a lot less on book value? Forget the PEs, they're in the single digits or almost. So there's not a lot of froth. There's not a lot of fat on this bone. So I keep that in mind. All right, that was an interesting cluster there. Okay, so companies like Amazon. So momentum companies that are fast movers up and down. It's hard to say, okay, there's a bottom there because they move up and down 300-400 points so easily. I can tell you one thing, I don't chase Amazon I don't use Amazon as a run for safety. And if I'm long Amazon, I better protect it because it does move a lot. Depends on my time frame. So I can protect it in general by buying puts into Qs, maybe QQQ. Okay, so VIX, fear. The fear index is kind of misleading these days. Short term, I look at the VXX, but the VIX is too cheap given what's at stake. What? Yes, that's what I'm saying. It's too cheap. It's not even 20. How is that possible? We have the world falling off a cliff and it's not even 20? This was December? This is wrong. Either a complete fake out in the headline and all this is going to blow over, which, fat chance of that, I guess. Or the VIX is going to it's going to double in the next few days. So, just a statement. Technically, if this was a chart, I don't know what that is, VIX or XXX or whatever. Here's what I'm seeing. This orange line, I have to see where I started it. Looks like a giant bowl, right? The fear was extreme on Christmas, and then Powell said some good things and say, hey, the Fed net is out. And then we had a tizzy in May over what? Powell said it's a mid-cycle adjustment of sorts, somewhere around here, I think. And then if we break out of 25, we should do this in the VIX. So VIX 40 is totally doable if it breaks out of 25. So it was not even 20. And this is the one thing that doesn't behave exactly in technical because it's an emotional thing. It's just we push through lines like butter. VXX, this is a derivative, similar, and the neckline is a lot closer. That's why I said the VXX is a little better indicator here, because on the intraday movement, although it's an ETN, so it's almost designed to go to zero over time. In fact, if I plot it, I'll show you. This is a 5-year. No, wait. the VXX, they killed it, and they revived it as VXXB, and then they renamed it as VXX. Anyway, it is a neckline that it's been fighting with, and if they shoot above it, they go to this area, and if shoot above it, this white that didn't materialize in May will materialize here. So fear is really the enemy here. That's what's causing everybody to, because the data is not there yet. We still have full employment, etc., etc. All right, so what else did we do? IWM, it's the same as we already looked at it. Okay, so what about Google? Companies like Google. Good fundamentals. I already shared charts for it being tight with a move coming. Guess what? This first leg of the move, it's this one right here. If we see a bounce, we may finish the job down to here. Ish. It's losing an important pivot point area, so then the machines will start selling the rips versus buying the dips. Let me see on the SPY. Yep, same here. So until further notice, I would anticipate markets to sell spikes. So my comment from last week will extend. On green days, I book and fix. I don't chase. Depends on my portfolio. If I'm already long and suffering, I book. I don't chase. All right, I think I covered enough. Videos longer than I wanted, but I think it's worth it. If you have any specific questions on specific stocks, let me know. I'm going to pause it here and go check my list to see if I missed something big. I don't think so. I guess I can look at the collective of, yield. Did we do yield curve? Okay. This is a yield curve. This is inversion. So it's still in, one is flat. So we closed flat. And another one I can show you for big picture is FANG. This is the collective of FANG, Facebook, Amazon, Netflix, Google, two tickers in Google. It kind of looks like the IOITs, don't they? And you can add Microsoft and Apple in here. It wouldn't change much. Apple. So look, it didn't even move. So they're all in the same boat. We shall see. All right.